Welcome back to the deep dive. Today, we are doing something a little different. We're focusing on Hippo Holdings, that's HIPO, but we're skipping the prepared remarks from their Q3 earnings call.
Right. We're going straight to the good stuff.
Exactly, the Q&A. That's where you find out what's really going on, what the analysts are worried about, and, what the real strategy is.
And the context here is really important. Management just put up some transformative numbers.
They really did. I mean, they hit a net combined ratio of 100%. Before we get into any of the questions, we have to talk about what that number actually means. For HIPO, that's a monumental shift.
It absolutely is. In property and casualty insurance, the combined ratio is, well, it's everything. It's your claims paid out plus all your expenses divided by the premium you brought in.
So 100% means you broke even.
You broke even on your core business of writing insurance. And given HIPO's history, as an insurtech, where combined ratios were often pushing 120, even 130%.
Because they were just chasing growth at all costs.
Exactly. So hitting 100% shows their long, painful strategy of getting disciplined and focusing on risk is finally paying off.
Okay, so the analysts get it. The turnaround is real. But their job is to stress test the future. They want to know how HIPO sustains this, right?
Yeah.
How do you stay profitable while also trying to double your premium base?
That's the tension right there. Stability versus massive growth. And that brings us right to the first big topic, the one that jumped out at everyone.
Their casualty business.
Yeah, the huge shift into casualty.
Okay, let's unpack this. The growth there was staggering. Casualty is now 25% of their gross written premium. I mean, last year was just 14%.
It's a breakneck pace. And so Andrew Anderson from Jefferies was the first to jump in and ask, what is this business? What's driving this growth?
And it's their big move into commercial insurance.
Right. The CFO, Guy Zeltser, he confirmed it's a mix of things. Cyber insurance is in there, and also commercial general liability, or CGL. And that's, covers basic business risks for small businesses, real estate investors, even construction.
And here is where it gets really, really interesting. Because that kind of growth sounds incredibly risky. But the CEO, Richard McCathron, he detailed this safety mechanism they're using, these fronted lines.
This is crucial. This is the key to their whole strategy right now. When they say fronted lines, what they mean is HIPO, as the licensed carrier, puts its name on the policy.
So they issue the policy.
They issue the policy, but then they immediately pass almost all of the underwriting risk, all the liability, to somebody else, usually a big reinsurance partner.
So they're acting as a fronting carrier. But what's the point if they're not taking the risk?
Well, they get two huge things. First, they get fee income, which helps the numbers. But more importantly, they get data. McCathron was very clear on this. When they grow this fast in a new area, HIPO does not take the risk at first.
So they're being paid to learn. They wait until they have, and I think this was the quote, strong comfort and a historical reference point on the profitability.
Exactly that. They start these programs, as he said, fully funded, meaning the reinsurers are on the hook for 100% of the initial risk. HIPO only, and very gradually, increases its own net retention.
Which is pretty small right now.
Very small. And they only do it after the data proves the program is profitable. It's a highly disciplined way to get into these new, riskier commercial markets without blowing up the balance sheet they just spent years fixing.
That makes them look less like a traditional insurer and more like a specialized managing general agent, an MGA, that just happens to hold a license.
It does. It gives them the option to become a full risk carrier later on.
But it raises a huge question, right? If you're not taking the risk now, how do you prove you'll have the expertise and the capital to take it on profitably 3 years from now when those fronting fees maybe dry up?
And that is the multi-billion-dollar question. And management's answer is data. They are betting that their tech and their data gathering will let them underwrite better than the market when they finally decide to keep that risk.
So data validation first, risk-taking second. Okay. Let's pivot from the shiny new growth engine to the legacy business.
Homeowners.
It's still the biggest part of their history, and here the questions were all about pricing and competition.
Yeah, this is the other side of that balancing act we talked about. They have to grow the new stuff while keeping the old stuff stable. And what's happening right now is a big change in the competitive environment, specifically in what's called the E&S market.
Okay, could you just quickly break down E&S versus the admitted market for everyone listening?
Sure. So the admitted market is your standard regulated insurance. Think state-approved rates, state-guaranteed funds. The E&S market, that's excess and surplus, is for the risks the admitted guys won't touch. It's less regulated, more flexible on price.
And after big catastrophes, a lot of people get pushed into that more expensive E&S market.
Right. And what HIPO's management is seeing now is the reversal of that trend. The E&S market is softening. Prices are coming down.
Which means customers are starting to go back.
They're starting to go back to the admitted market, which is rebounding. And HIPO expects that to continue.
So, okay, the market is getting more competitive, prices are softening, but HIPO's management says they feel very good about their current homeowners book. They're saying they have the rate they need.
Yeah, they said they don't see any big repricing on the horizon, just, small increases for inflation.
That confidence seems, well, it seems pretty remarkable given the environment.
It is, but I think it's earned. It reflects all that painful work they did. I mean, they exited entire states, they shed policies, and they focused almost exclusively on new construction, new homes through their Westwood partnership.
Because a brand new house is just a much cleaner, more predictable risk than a 50-year-old one.
Dramatically cleaner.
Yeah.
So they're basically saying, we've done the hard work, we took our medicine, now we're stable. The challenge is just holding that line on pricing in a market that's getting tougher.
Which brings us to the long game. Jean, who was on for Tommy from KBW, tied this all together. She asked about their 2028 goals and how this super disciplined homeowners book fits into their huge premium targets.
And that target is an eye-popper. Management is aiming for over $2 billion in premium in the next 3 years.
That's nearly doubling where they are now in a very short time.
It is. And this is where the whole diversification story really comes into focus. McCathron was clear. Even though the homeowners line shrank as a percentage of the business from 47% down to 32%, it's actually going to grow in absolute dollars by 2028.
That is a crucial nuance. So more homeowners premium in total, but it's a smaller piece of a much bigger, more diversified pie.
Precisely. And that growth is coming from very specific places. The Westwood Partnership, which they expect to triple their new home construction business and their manufactured housing programs. But by 2028, it's just one piece of the puzzle.
And the real metric here, the proof that the diversification is working, is the shift in net written premium.
That's the one to watch. That's the risk they actually keep on their own books. The CFO pointed out that net written premium for homeowners has already dropped from 86% last year to 64% this quarter.
So the goal is to see that number keep falling. That's the real story of risk reduction.
It is. And finally, they talked about how they're going to pay for all this, capital allocation. And they laid out a dual focus.
The primary focus is clearly on growth and infrastructure.
Yep. Building the portfolio and building the surplus they need to support that $2 billion plus target. They have to have the capital base to eventually retain more of that risk they're fronting today.
And the secondary use, it shows they're willing to take a shortcut if one appears.
Right. Opportunistic acquisitions. They said they're looking to buy entities that will further diversify the portfolio and accelerate that diversification. So they're ready to use M&A to hit that target faster.
And they did mention they bought back some stock, about $15 million worth, so they're not totally ignoring shareholders, but the focus is clearly on growth capital.
It's all about building for 2028.
So what does this all mean for you, the listener? HIPO is raising guidance, they've hit underwriting break-even, and they're executing this very controlled diversification plan.
Right. The control comes from growing fast in new lines like casualty, but using those fronting deals to strictly manage the initial risk.
Yeah.
And the stability comes from that laser focus on low-risk new-build homes in their legacy book.
The takeaway really is that HIPO has moved past just proving it can grow. Now it's about proving it can underwrite profitably while it expands.
And if you're tracking their progress, you have to watch two things. The gross premium mix for the diversification story and the net written premium mix for the real risk reduction. That's the roadmap they just gave us for the next 3 years.
It certainly is. Now, here's a final provocative thought for you to chew on. Management feels good about their current homeowners pricing. They say they only need small inflationary increases, but they also admit the market is getting more competitive as the E&S market softens. So, given their goal of reaching over $2 billion in premium doubling their GWP, how long can they really resist downward pricing pressure to keep growing that book? Does hitting that $2 billion target mean they might have to sacrifice some of that hard-won pricing adequacy they just spent 3 years building?
That's the question.
Something to think about as you watch HIPO's next steps. Thanks for joining us for this deep dive. We'll catch you next time.